Chart observation. Anatomy of the Asian range stop hunt. During a stop hunt, it is normal to expect that the reversal will occur somewhere between 25 and 50 pips higher than the Asian range. It is also normal to expect that this will entail a journey of 3 pushes or candles to get there. However, it is not that simple, and the 3 pushes may occur in increments of different sizes. It is important to remember this when assessing the movement as it escapes the Asian range, and to not simply expect a straight 3 candle movement. For example, the first push or candle may be a full 25 pips. At this point, price may be held for 3 or 4 candles taking a full hour. At this point, it is pushed up another 20 pip, making a total of 45 pips from the top of the Asian range, and finally another 5 to 7 pip on top of that. The effect of each these moves as follows. 1. Range traders who have taken short positions at the top of the Asian range will have a stop loss somewhere between 25 and 50 pips from this point. Therefore, the initial 25 pip push will take out the first of the stops. 2. The first upward movement will begin to entice traders to take long positions on the basis of a breakout trade. 3. This is accentuated by the following period of consolidation where price is being held and traders will be expecting a continuation pattern to develop. 4. It is further accentuated with the next 20 pip push, further enticing long positions as price has now been rising for an hour and a half. 5. The last 5 to 7 pip, it is about taking the last of the 50 pip stop losses from the range traders. The last move is almost always just a tap, identified as a pin. The main reason for this is that it costs money to move the market, and this is a cheaper option for the MM. Anatomy of an M and W formation. The M or W pattern is a frequently identified pattern and is a particularly good reversal pattern. The following diagram shows the reasons for the movement in terms of the market maker's use of the pattern. It is also worth noting that a RRT pattern is really an M or W pattern that has occurred more quickly and thus has the same effect. The time gap between the 2 peaks of the M or W will usually last for somewhere between 30 and 90 minutes, though occasionally longer. The fastest occurs when the pattern is defined by a railroad track, in other words 15 minutes up followed by 15 minutes down. Longer periods are also common and used to gradually accumulate more positions of traders who are enticed into taking trades in the direction of the technical trend. Trapping volume. At a peak formation low or a peak formation high, several spikes may appear which are all apparently contained by a trend line. But what is really happening here? The MM is trapping volume, and it is important to notice that each subsequent spike, it is not lower or higher than the previous, so that any new trades taken in the direction of the spike do not have an opportunity to become profitable. They become trapped. So in the example below, the peak low is identified and followed by 2 further downward spikes. The important feature to notice is that each of the spikes is higher than the previous, which prevents short position holders from taking any profit whilst potentially encouraging new shorts in this region. The wedge redefined as a volume trapping mechanism. In a similar way to the mechanism of trapping volume described above, a wedge or pennant pattern works in much the same way, except that it is trapping volume in both directions. In the example below, you can observe that on the lower boundary of the wedge, the peaks become slightly higher each time it comes down to the line. This has the effect of ensuring that none of the trades that are taken short in these regions can turn a profit. Similarly, on the upper boundary of the wedge, the same thing is happening, with each of the peaks becoming progressively lower and trapping the higher level longs and pulling them down. There is no way of predicting which direction the price will ultimately break out. This will be determined by the net volumes that occur. In other words, if there is a greater buildup of short positions over the long positions, then the wedge will break up. Maintaining the validity of highs and lows. As long as the price stays above the low after your entry or below the high after your entry, then the entry and therefore the trade remain valid. Some caution needs to be applied when interpreting price movement that exceeds the high or low but closes back inside the noted high or low price. In these situations, the market makers have spiked the price beyond the high or low to both trigger stops, as well as to further induce traders to enter in the wrong direction. False support and resistance levels. Consolidation zones are created during the cycle to create support and resistance levels which become visible on the charts and are used by traders to make decisions. These levels can then be predictably used by the market maker to plan strategy. With this understanding, you can buy or sell stop hunts against the herd and in line with the market maker moves. Simply buy the level 3 corrections and sell third level rises. The anatomy of the half Batman pattern. This pattern commonly occurs at a level like consolidation and is similar to the straightaway trade. Essentially, there is no need for a second move back to the high because there are already traders trapped from further up and the does not want to provide an opportunity for them to close their trade at a profit, or even a small loss. Instead, price is moved down, providing an inevitable loss to the traders. Weekly price movements. The weekly pattern does not imply the use of a weekly time frame. It refers to the pattern that is seen in a 15, 60 or 240-minute chart over a period of a week. However, MMs also have seasonal variations of price movement, and so it can be seen on longer time frames, though it is probably too slow to be traded effectively. The 3-day cycle. A typical pattern of behavior, particularly when examining the 3-day cycle, is to be able to identify a peak high followed by 3 moves down and a reversal which forms the peak low. Each time price moves down a level, they can be referred to as achieving or making either a level 1, level 2 or a level 3 move. Level 1 and level 2 have relatively similar patterns of behavior, 1, 2, 3 stop hunt. However, level 3 tends to be choppy with a wide range and represents an area of profit taking for the institutions, and signifies the beginning of an accumulation period for another cycle. The reasons for this behavior can be understood if you consider what happens during the rundown. 1. On day 1, you, the retail trader, are selling and the institution buys from you. 2. On day 2, you are selling and again the institution buys from you. 3. However, on day 3 the retail trader is again interested in selling and the institution buys up heavily. 4. Now they move price up aggressively, triggering stops and taking a profit. In effect, they are using a scaling method to book their profit. 5. Following a level 3 pullback, price becomes choppy and continues because of what happens with the trader's psychological adaptation to loss. After the market has run down for 3 days and traders have taken losses, these individuals react by pulling away from the market quite literally and having a few days off before coming back to trade. During this period, the market is choppy and relatively stagnant until the traders have returned to play in the game again. To remember the patterns, use the following. 1. After a big drop, the market must chop. 2. After 3 days of drop, the market must chop. 3. After a big rise, the market needs more guys. 4. After 3 days of rise, the market needs more guys. Also, it is again worth remembering that the patterns are similar in different time frames. Additionally, the areas of reversal in both are often synchronized so that they occur at the same time in different time frames. Using this knowledge, it is possible to convert a spot trade into a swing trade when you enter it from a peak formation high, peak formation low. If you are prepared to continue adding to your position as the trade progresses in your direction, it is possible to make very large profits, as the whole move might be as much as 300 to 400 pip with numerous possibilities for supplementary entries. Another way of recalling this key issue is the patterns are the same no matter the time frame. So it is obviously important to count the levels so that you know what part of the cycle price is in at the current time. Quite obviously, if you are able to enter a trade at these peak reversals, then you are in a good situation to run your trade for the full extent of its journey. So, to win in the market, you should only take a long position when the LOD, HOD is clear. This is the only place that has a high level of certainty in directional movement. It is also important in making these assessments to consider the bigger picture and where the market is in cycle. This includes looking for a midweek reversal, which will generally correlate with one or both of the intraday reversals. With an awareness of the longer cycle and assuming you are in the correct place within the cycle, it is possible to convert a spot trade to a swing trade from one of the 3-day cycle peaks to the other given an appropriate entry. This would involve going from one peak formation high to the next peak low and may take several days. On an intraday trade, it is still important to understand where you are within this larger cycle, as it will help you to make a judgment about how far a run might last. For example, if price has just passed the peak high and is at a level 1 accumulation, then an intraday long trade after a bearish stop hunt, while valid, will not be likely to produce consistent results. Hence, it is a good idea to not take trades against the longer trend at a level 1 accumulation,